Hello traders, this is Frank Paul from Forex Mentor speaking with you on Wednesday, August 15th, 2012. Welcome to our weekly free video demonstrating the latest trading system in rotation within the FX Systems Lab monthly series. This one, the directional movement trade. Just a quick overview here. The directional movement trade is a trend trading system that is scalable to suit all of the main trading styles as desired, that is position trading, swing trading, day trading, even scalping, using time frame specific trade entry and trade management rules to guide the process from start to finish. Just in case you're wondering, yes, we do document those trade entry and trade management rules in painstaking detail within both our online course content and a downloadable PDF cheat sheet, as we call it, a typewritten detailed overview of these trading rules, which are available to members in the members area at FX Systems Lab monthly. Now, because no indicator reading is ever consistently reliable on a single time frame, we look for the same DMI reading on multiple time frames and combine that with the power of swing points to highlight a trade opportunity. The procedural steps are as follows. First, find a top-down screening result, that is the same DMI reading on 4 consecutive time frames. Then drill down to a fifth so-called execution time frame to find a counter trend swing point pattern. Determine the proximity of price action when that swing point materializes in relation to the daily ADR target. The idea being here that if you're too close to the projected high or low for the day, don't act on that signal. Wait till you've got a bit more gap to play with. Identify the initial protective stop level, which is 5 pips on the other side of the swing point, which serves as the entry trigger. Identify the expected profit target on the trade, which is variable based on trading style, position, swing, day trading, or scalping. Assess the reward to risk potential of the setup. If it's favorable, proceed to step 7, which is to double check the screening result, because sometimes, depending on the scale of the trade, particularly for position trades, by the time you get an execution signal, it's not entirely unlikely that the momentum reading on at least one of the time frames may move out of sync. Not always, but it happens often enough that it's worthwhile protecting yourself against that scenario, because it might indicate a retracement which could trigger a stop or result in a drawdown. So let's just redo step 1. Find that top-down screening results, make sure it's still intact. If everything looks good to this point, we enter the trade, immediately applying the initial protective stop and limit exit or exits, as the case may be. Manage the trade through to completion, which means essentially trailing the stop to break even to remove risk, and then occasionally trailing the stop further to lock in profit, and following the trade through to completion, whether for win, loss, or draw. When it's all said and done, conduct a post hoc review to see what we can learn from this particular experience. Here are the trade review details that I'd like to share with you for today. We're going to look at a chart illustration for Swissy yen with a short bias, swing trade bias that is, swing trade short, July 6, 2012. The 4 time frames that have to line up the same way based on DMI are the weekly, daily, 4-hour, 60-minute charts, the execution time frame being the lowest of the 4, that is the 60-minute chart. The entry bar for the open for 4 a.m. GMT July 6th at an entry price of 82.40. A very tight initial protective stop of 15 pips was allowed on this trade, which is just fantastic because when you calculate the ADR based profit targets, in this case P1 at 81.21, P2 at 79.92, you get target profit in the amount of 119 pips on the first lot, 248 pips on the second, and in relation to that really nice tight stop of 15 pips, we get really high reward to risk multiples. 7.9 on the first lot and 16.5 on the second. Absolutely fantastic. So let's see how all these details played out on our charts and see if we can tease out the trading methodology for this month. We're looking at a 4-chart tiled display for the Swiss yen pair now, and the very first step is to find the same momentum reading using the directional movement indicator on 4 consecutive time frames for a swing trade that comprises the weekly, daily, 4-hour, and 1-hour charts. So what I've drawn here by way of this dashed vertical line is what each time frame in question here looked like at the same point in time. So we begin with the weekly chart and have a bearish reading for the week of July 2nd, 2012. That is conveyed by way of the red DMI minus line residing above the green DMI plus line. And I've got a easy little color zone effect here, whereby anytime the red line's above the green, it paints in red, which is obvious in its implication, it's bearish, and vice versa. Anytime the green line paints in above the red, it's green. And we've got histogram bars lining up the same way. So this is a bearish momentum reading on the weekly chart. DI minus above DI plus, red histogram bar. That's how you read it simply and effectively. But never on one time frame only, because you might get lucky and try to go short just based on this reading. More likely you're going to be unlucky and find that you get stop triggered out of the trade because of counter trend moves on lower time frames. So that's why we try to accommodate 4 consecutive time frames, to make sure that we're waiting until there's no apparent counter trend action on any substantial time frame which could affect a trade before jumping in. So then we drill down to the daily chart, and for July 6th now we can see a bearish reading. In fact, we had a bearish crossover in the background here, sort of short-lived counter trend green reading reversing to red on the close for July 5th. On the open of July 6th, anytime thereafter to the far right hand side of the chart, we've got a bearish reading. So we're 2 for 4 now. We've got the weekly and daily charts as of July 6th lining up bearish. We then drill down to the 4-hour chart, and for the midnight GMT bar, or sorry, 4 a.m. GMT, well, midnight GMT too, in fact, all the way back to here, we've got another bearish DMI reading, the DI minus line above DI plus. Okay, I know this looks like a slightly funky kind of indicator layout, but when you know how to read it simply and effectively, it's very easy to deal with. It's either bearish or bullish. You're not going to really get meaningful divergence signals or anything like that from this particular indicator, but what you are going to get is a reasonably reliable momentum conveyed by the same reading on multiple time frames concurrently. So then we drill down to the hourly chart, and as of 4 a.m. GMT, not only do we have bearish momentum here right across the whole chart time frame here, but something interesting has happened, specifically a swing point high, which is a potential entry trigger. And at the bottom of the chart here, I've got this sort of sawtooth pattern. This is a swing point indicator, and any time that you have an up arrow kind of indicator on the close, in this case for 4 a.m. GMT, that tells you that 2 bars back from the point you've got a swing point high, pointing up for a swing high, pointing down for a swing low. Now if we're bearish, we don't really care too much about swing point lows, not as entry triggers anyway. We're looking for swing point highs. So we've got a pointer right through here. 3 a.m. GMT, it tells you 2 bars back there is a high that was preceded by 2 higher lows and then followed by 2 higher lows. So it is by the open right here where I've got the dashed line drawn, 4 a.m. GMT, where we're looking to go short. And before we get into the trade, we really want to pay close attention to reward risk. Okay, and one element of that, of course, is risk, and that's defined by a dynamic stop, whereby we place the stop 5 pips above that swing point high in the background. So the high for 1 a.m. GMT, July 6th, is 82.50. So I'm going to add 5 pips to that level and think about a protective stop at 82.55. I'll just paint it in red to remind myself that it's a resistance-like level that I'm dealing with here. So from 82.55 down to the open for 4 a.m. GMT at 82.40, that's your nice tight 15 pip spread right there between entry price and protective stop. Not factoring in dealing spread, so maybe we would have to pay 18 pips, but that's still really, really good. And then what we do from here, and I won't go into the details too much, that's all reflected in our video course, to determine the take profit objectives for a swing trade, you zoom out to the daily chart and look at the ADR figure for the day, which I've got conveyed by this indicator on the bottom here. It's a custom indicator which you can grab a copy of if you happen to use the Pro Realtime platform. And if not, if you use MT4, we can provide it for that as well. So it just tells you what the 5-day ADR figure is, and on this particular day it's 129 pips. So from the high of the day, you subtract 129 pips to get your P1 target, and then from that same high for the day, you subtract 2 times the ADR to get your P2 target. And I can tell you for this particular trade, we were fortunate enough to see both objectives met. Let me pull up the daily chart. If you remember from our summary page, we were looking for P1 at 81.21, which was all the way up here, in fact. And I'll paint it in green because it's sort of like support. A limit exit target. And then our second limit exit was at 79.92. Again, there's nothing magical here. It may seem like this was a cherry-picked example or what have you. It doesn't really matter because the method is the method. It's documented in detail. It says from your entry point, subtract 1 times ADR. That was achieved here. And subtract 2 times ADR. That was achieved here. And trailing the stop to break even after sufficient floating profit to make it a risk-free trade. All it was thereafter is a waiting game. And then we got both of our limit objectives handily realized. And that's pretty much it in terms of how you apply the directional movement trade. Of course, I'm leaving out a few important details which you need to apprise yourself of before you go and use this particular system. But what I'm trying to do here today is just convey how it works in the broad strokes. And that's our look at Swiss yen for today. Thanks for joining us today. I hope this video has given you some useful and helpful ideas for your own trading. If you'd like to find out more about FX Systems Lab Monthly, which posts 12 richly detailed and presented trading systems in 12 months, one per month obviously, including 3 times weekly narrated video rundowns for each monthly trading system, 12 in total each month, a cheat sheet PDF, and other features. All of that is available to you for a very value-conscious price of $99 a month. On a pay-as-you-go basis, we also have longer-term membership options available, which provide even greater savings. So please do check us out, www.forexmentor.com/systemslab. Any questions you might have, please feel free to direct them to me via frank@forexmentor.com. Thanks for joining us today. Have a great rest of your week, and we'll talk to you again real soon.